Thank you very much for joining us today. I'm really excited to introduce you to today's guest, John De Goey. Now, John is a portfolio manager, author, and podcaster with his company, Stand Up Advisors at Design Securities. Now, John has an interesting background. He is a veteran of the financial services industry and is a long-standing advocate for professionalism and transparency in personal finance. He's got some fascinating insights into human behavior. And it I love everything related to human behavior and mind management. We all have biases and blind spots. And the first step to overcoming them is to recognize them. He was twice named one of Canada's top 50 advisors and is the host of the Make Better Wealth Decisions podcast. John is the author of 3 books. Most recently, let me pronounce this carefully, Bullshift: How Optimism Bias Threatens Your Finances. So, John, thank you so much for being here today.
Thank you, Helene. My pleasure.
And I want to start off with your expertise in behavioral biases and decision making. So, if you mentioned that as a part of your elevator pitch when you first met somebody, how do you explain to somebody what is behavioral bias in decision making?
The first thing that needs to be said is what you mentioned in the intro, which is that we're all biased. And so you can't talk about it in terms of being superior or intellectually superior. It's really a question of knowing yourself, being self-aware, and thinking about how we all have biases. And the first step to overcoming them, of course, is being aware of them. You can't fix a problem that you're oblivious to. So
Mm-hmm.
the elevator pitch is to help people make more informed decisions. My podcast is called Make Better Wealth Decisions. And that in turn is based on being aware of what the biases are and then so we act them in as much but it's about awareness, checking motives at the door, thinking about what it is you're really trying to do, and being purposeful and intentional as you make decisions that hopefully will be what's best for you.
Excellent. And I'm so glad that you are emphasizing the decision making, because if anybody is listening to this time management podcast, they might be scratching their heads. Why do you have a finance guy on there? And it is because of your relationship and your expertise in the decision making part, because that ties in directly to time management, because time management is all about decision making. So, going back to you and your expertise, have you always worked in this field? And if not, where else have you worked?
I've mostly worked all in this field. I've been doing this for 31 years. I'm that old. You can see how gray my hair is. I did for a very brief time work in the government. I actually did a graduate degree in public administration. So a master's in public administration is like an MBA for government, where you study to be a civil servant who understands public policy and makes decisions with regard to things like trade and taxation and other things that are very much transferable to being a financial advisor. But I was originally looking at working in the public sector, and I did some co-op jobs when I was doing my graduate work, and I did do a one-year contract at the provincial utility. But since then, since September of 1993, I've been a financial advisor the whole way through.
Oh, nice. So plenty of experience coming from your way. Uh, Digging into these biases that we all have, what sorts of biases do we have as humans and in particular as investors?
So this is now the meat of where we're going. The main thing about many biases, perhaps even most biases, is that they're unconscious, which is to say we're biased, but we don't know we're biased. And so how do you fix something that you're oblivious to? That really becomes a problem. And the research shows that the best way to overcome your biases is to have a partner, someone that you can talk to, a spouse, a sibling, a best buddy, to say, here's what I'm thinking of doing, and what do you think? And to see if in fact you're doing things that are ill-advised, or if there's an angle that you're missing. And so we all have them. So there's optimism bias, which is what I talk about in bullshit, but there's recency bias, and there's overconfidence, and there's a whole bunch of things about sunk costs and whatnot. All of these are things that will take a person who believes that he or she is rational and demonstrate that they are less rational than they thought, and that they will do things, they make decisions based on things that go back to caveman times, based on the amygdala, and making decisions that are snap decisions that are based on the way we've evolved, when in fact the 21st century really involves decision making that are more contemplative, and you need to be able to overcome the reptilian knee-jerk reaction and stop and step back and think more purposefully about what it is you're trying to accomplish. And that includes questions that involve time management.
Hmm. So interesting. Well, taking a step back to the beginning of what you were saying, where you find somebody who you can confide with and bounce ideas off of, what if your spouse or your best buddy has no expertise in the financial world? Would you still consider them good candidates? Are you supposed to look for somebody specific that you should want in a confidant?
Most of the time, you don't need to have specific expertise, because it's not, the decisions that you're talking about are not about, what should I put into my 401k. I'm not talking about that.
Mm,
I'm
okay.
talking about making decisions that might help you to overcome procrastination, and
Mhm.
holding you accountable for the decisions you make and the reasons you make them. I want to save some money to put my children through school. Okay, well, you said, you made the New Year's resolution. Now it's February. Have you put the money aside yet? And so that kind of accountability is important, because it helps. It's like having a training buddy if you're doing a workout routine or anything else. Having someone who will hold you accountable, and who will be a sounding board for what you're doing and why you're doing it. They don't have to know the specifics of your life. They don't need to know the details of building a diversified portfolio, and optimizing for tax. And those are the sorts of things that are, it's nice to have, but they're by
Mhm.
no means needed in terms of improving your decision making.
Okay, great. So you don't have to go out and look for an expert yet for those general
Right.
accountability principles. Obviously, you'd want an expert when you get down to the nitty gritty of actually planning. So, based on all of your experience, you've had 31 years of this type of experience. What do you find are some common roadblocks that your clients or people you work with might have?
So I'm going to talk about optimism bias because it's one of my favorites, and it's a roadblock that we all have. And I'll give you a few examples, because you're going to recognize this right away. Study after study has shown this throughout all of history. When you ask the average person if they're an above average or below average driver, statistically, about 80% of people will say they're above average. But we all know that that's not mathematically possible, that only 50% can be above average. When you ask people who are newlyweds what the odds are of getting married, of getting divorced on their wedding day, unsurprisingly, and you can tell them unprompted, oh, by the way, the statistics are throughout the Western world, about 40% of all marriages end in divorce. So you ask people on their wedding day, so what are the odds that you and your spouse will divorce? And the happy couple will say, oh, I don't know, zero. They optimism bias is a problem where people understand the macro evidence, the facts, but for whatever reason, they don't think those facts will apply to them personally. It's like, okay,
Mhm.
people get divorced, but I won't get divorced. Oh yeah, there's people have car crashes, but I'm not going to be in a car crash. So this is a bias that we all have it. It's not like it's just human nature, but you need to overcome it. But the thing is, when I pointed out that 80% of people think they're above average drivers, people go, yeah, I know that I think that. And they sort of laugh and they chuckle. But it's a problem, because we tend to gloss over risks, because
Mm.
we're overly optimistic about what the odds would be about, if you're buying a company that's an initial public offering, or a high risk stock or exchange traded fund or what have you. People always have the dollar signs flashing in their heads about the great outcome, but you need to understand that risk and return are related. And the higher the expected return, the greater the risk that you're taking in order to expose yourself to that return. But when you ask people at the beginning, before they make the investment, they tend to focus a lot on the great return, and they tend to gloss over the risk they're taking in order to hopefully get it.
Mm. Wow, so true. And you're right. It relates so much to time management because a lot of those same principles can apply. A lot of those same situations can apply. So we've got the optimism bias. We have other roadblocks that you mentioned in one of the earlier questions. How do we know when to proceed quickly? How do we know when to be more deliberative? And what's the how and the why of all that?
So one of the things I was thinking of when you were speaking is an old phrase that I once came across with the consultant that I was working with on decision making, and that was, if you didn't have the time to do it right, where did you find the time to do it over?
Mm,
And so a lot of this is, and the carpenter's rule is measure twice, cut once. And so what we have to do is we have to there are certain things that you don't really, I mean, you don't have to be deliberative about what you're going to have for breakfast. You can maybe to make a conscious decision to eat healthier foods and to cut back on your third coffee or what have you. But for the most part, that's a decision that you make philosophically at the beginning, and you don't need to think about much thereafter. But you should be very deliberative about, for instance, the risk you can tolerate. And you can make a promise to yourself, but again, a lot of research shows people will say, oh, I can handle the risk, and they're all
mm,
gung-ho and ready to go, until what Mike Tyson used to say, everyone's got a plan until I punch them in the face, right? So everyone thinks they can tolerate the pain of a market drawdown, and then they'll say, oh, I can withstand a 20% drawdown, and maybe they can, maybe they can't. But what if the market goes down by 20% and stays down for 3 years? You,
mm,
you can withstand a 20% drawdown if it goes down and comes back up again, like it did in COVID in February, March of 2020. The market went down by about a third, but then it hit a bottom. And because of government policy and interest rates going down to effectively zero and governments handing out checks willy-nilly, the market rebounded and started going back up again. So as long as you didn't panic in the 5 weeks that the markets dropped, chances
mhm,
are you were going to be fine. But what if, instead of having the markets rebounding in March of 2020, markets stayed down? And what if markets today were where they were in 2020 after the drawdown? Then would you have that kind of stick to itiveness? And I dare say most people won't. And I would also say that one of the considerations that you need to think about when you're making decisions about what your risk tolerance is, and how to set it, and how to stick to it, is your station in life. Specifically, are you retired or not? Because if you're still working, you can quote unquote buy the dip. And when the stock market drops by 10, 20, 30%, if you're still working, some people think it's a great opportunity. They back up the truck and they buy as much as they can when stocks are on sale. But if you're retired, that money that you have in the market, whatever it's invested in and however it's diversified and whatever else, that's all you have in the world. You might own a home, but for most people, all they have is their investment accounts, their retirement accounts, and their residence. They can't buy the dip. They can't buy more when stocks are on sale. They need to be able to live for as long as they live, and life expectancy keeps on creeping upward. So that might be 15, 20, 25 years for some people.
mhm,
um, that money's got to last a long time, and you've got to be able to have it last a long time, despite, for instance, in 2022, stocks and bonds both dropped by about 15% in 2022 in the first 8 or 9 months when interest rates went up. Well, that's the sort of thing that really pinches. If you've got a million
mhm,
dollar portfolio, and 9 months later you're looking at $850,000, and your plan was that you're going to live to be 90 or 95, and that $1 million was going to last you until then, and you're now 70 or 75, and now you're down to 850, and it's like, oh geez, if you do the math on taking the money out, 4% or whatever per year for the next 20 years, it's not going to give you the lifestyle that you thought you were going to get. And then you've got to start thinking about, well, what am I going to do to change my lifestyle? That's a
mhm,
difficult decision that a lot of people have not really come to terms with. They simply say, oh, I've got a plan, or I'm working with someone, or my guy says I'm going to be fine. But they don't think about how they might need to be nimble and adjust their plan and make a decision that will help them to stick to whatever it is they need to accomplish. And some of that involves some time management and planning on the front end.
So important. And I realize that if somebody does not have any experience in this area, or maybe they haven't thought about retirement, they might be 25 or they might be 45 and they've never thought about these types of investments. The question that I want to ask you has to do with how can you make investing simpler and more consistent? But as you answer this, do you think you could differentiate in the various decades? Like, what should somebody in their 20s be thinking about as far as how to do this more simply versus somebody in their 30s or 40s or 50s, 60s?
Let's do that. So there's a guy by the name of Richard Thaler, who's a professor at the University of Chicago, who won the Nobel Prize in economics, I'm going to say 7 or 8 years ago,
Hmm.
who's written or co-written a couple of books. One's called Misbehaving, and he co-wrote another bestseller called Nudge that you may have heard of. And if you've ever seen the movie The Big Short, he actually has a cameo appearance where he's there with Selena Gomez at the craps table over in Vegas, and they're talking about
Hmm.
putting bets on bets. So that's Thaler. So one of
Okay.
the things that Richard Thaler is best known for is something called the Save More Tomorrow plan. So this is a set it and forget it principle that is based on defaults. So if you have an employment program, so you're in your 30s or 40s and you're embarking on your career, and your employer says we've got a group pension plan, and if you put in 4%, we'll match 4%, what have you. A lot of people will sign up for the plan and think it's a great idea. And then we have inflation, and inflation right now for the past number of years has been high. It's been probably 4 or 5% for the past 2 or 3 years, and now it's closer to 2 or 3%. It's closer to the more historical numbers. But most people, through their work, through their contracts at work, will get pay raises that are commensurate with inflation. So if inflation is 3% last year, you get a 3% raise this year, or something like that. But if you're saving, pick a number, $300 a pay, and your employer matches it with $300 a pay, and your pay goes up by 3%, well, shouldn't you be saving $309 per pay and having your employer match? So a lot of people set it initially based on their current
Mm.
pay, but as their pay goes up, they don't increase their savings rate commensurate with their pay going up. They spend the extra pay on lifestyle, and so their savings rate as a proportion of what they're being paid is actually dropping. And they don't think about it because they set it when they set it up. So one of the things that you can do to save time and to save money is to find an employer to say and sign it in the contract when you sign up, I will save X number of dollars, and that X percent or whatever it is will go up as my pay goes up. So if my pay goes
Mm.
up by 3%, my savings rate and the amount that you match, Mr. Employer, will also go up by the same amount as my pay, so that you continue to save a similar amount. And if you're even more thoughtful and proactive, if you want to be a really good person who says, you know what, I'm doing better than I ever thought I would, maybe you can actually go in and proactively once a year say, you know what, Mr. Employer, instead of saving 3% more, how about if I save 5 or 10% more? You do it once. It only takes 5 or 10 minutes with the payroll department. It comes off before you get a chance to spend it on something else.
Mhm.
And that one simple decision that costs you 5 or 10 minutes in December for the coming January will help you to reach your financial goals, and you probably won't even remember you did it 2 pays into the calendar year. So that's an
Mm.
example of what you can do when you're young. Okay, so
Okay.
you asked for different examples and different time frames.
Right.
If you're older, I think a lot of it then becomes one of the decision becomes one of deciding to adjust your lifestyle based on what the market does. So let's say you're retired, you're 70 years old, and your government, you're required to make a withdrawal from your government retirement plan, and you need to take a certain percentage out. If you have a good year, you take out the amount that you have, but you can make a conscious decision, make a promise with yourself, put it in writing, have a friend hold you accountable, that if the market goes down, you will take out the minimum and no more. But if the
Mm.
market has a really good year, you can take out the minimum plus something and go on a trip or do whatever, treat yourself. But you need to be able to self regulate and to, instead of living high on the hog all the time or living with complete austerity all the time, you need to be flexible. And that flexibility requires you to be adaptive to the circumstances as you find them. The market goes up, you can take out a bit more. The market goes down, we got to tighten our belts for the next little while until we get through this. So that's an example of what you can do if you're older as well.
It's so important what you said. I have run into a lot of people who rest at one end of the spectrum of investment, as in, I don't know anything about it, so I'm not going to bother with it. And then the other end of the spectrum where they are all in with their financial advisor and don't understand anything that's happening. So the advice that you just gave, I think, is so important, because even if you don't want to be in control of your finances, you want to have that advisor or that consultant, you still have to have an idea of what's happening so that you can self-regulate in life. You can attempt to be proactive, and you can be more involved in your investments and your savings. As I get older, I've met a number of people who had planned to retire at 60 or 62, 65, and they hit that age. And it's at that age, it's the first time they're looking at all their finances and they haven't saved accordingly. So now they need to work longer. So if people take your advice and are proactive, it's going to help prevent situations like that. Let's jump over to your book. Can you tell us
Sure.
a little bit about your book?
Sure. Optimism bias is a, so the book is called Bullshift, and it's cute. And when you see it in the bookstores, people go, "Oh, what the? Oh, okay, I get it now." But what you have to understand is it's a pun. It's a portmanteau. You take two different words. When markets are going up, people feel bullish, and when you adjust the way you think about things, you shift. This is a book about how the financial services industry shifts people's attention to make them feel bullish. So,
Mm,
according to people in finance, the glass is always half full. And that's not necessarily a bad thing. Being bullish, being optimistic is a good thing as a natural predisposition. Another guy who won a Nobel Prize is a guy named Daniel Kahneman, who won the Nobel initially in 2002. He's he was emeritus at Princeton. He died about a year ago in his, I think he was about 90. But he wrote an international bestseller called Thinking Fast and Slow. And Kahneman, when asked if you could wave a magic wand and give a newborn child anything at all, what attribute would you give them? He said he would give children the gift of optimism or joy, because optimism correlates positively to a good life. It makes people more resilient. They are more resistant to illness. They bounce back quickly from a divorce. They bounce back quickly from being laid off. They do better. They live longer, and they live objectively better lives. So if you
mm,
could have any one element of life that could be a hallmark of who you are and how you approach things, it would be to be optimistic. And as such, it's a bit ironic that I would write a book about the perils of optimism bias. It's because the subtitle of the book is How Optimism Bias Threatens Your Finances. And people go, well, wait a minute, I thought you just told me optimism bias is a good thing. And the answer is yes, it is a good thing. But too much of a good thing can be dangerous too. And when I talked to you earlier about how people optimism bias is when people think, other people will get divorced, but not them, and they all think they're above average drivers. A lot of people will say, "Oh, markets will, they don't go up in a straight line. They go down sometimes too." So they acknowledge that markets will sometimes go down, but they somehow think that the markets going down will not have a major impact on them, that they will do a better job than most in weathering the storm. And my message to them is no, you're deluding yourself. You need to be open minded and thoughtful and clear headed about what it is you're in for. You're not special. If the market goes down, you're probably going to go down as much as everyone else, just like your neighbors, just like your coworkers, just like your friends at your bridge club if you're retired or what have you. And so, or the people you play pickleball with or whatever you do when you're retired. And so, if you think that you're special, the point of the book is, with great respect, you're not. You need to be
mm,
prepared for what's coming whenever it comes, and no one knows for sure when markets are going to turn, and no one knows for sure how long they're going to last. But the thing is, bear markets have not been outlawed. they're going to happen at some point. No one knows why, no one knows when, no one knows exactly how, but it's going to happen at some point. Are you ready? And have you made the conscious decision to steel up your resolve to be able to deal with it? And the concern that I have is the financial services industry always talks a good game about, oh, don't worry, you invest for the long run. Well, if you're 75 years old, people, the big joke is long run. I'm 75 years old. At this stage in life, I don't even buy green bananas. Like people just sort of say, like you come on, like let's be realistic about what the long run really means. And you can say that, and it can resonate if you're 35 or 40. But if you're 75 or 80, trying to tell someone there, take a long-term perspective, it may not work. I'll give you one example where this is really dangerous. And because you're not a finance person, you might not know this. But on December 31st, 1989, the Nikkei, the stock market index in Tokyo for Japan, hit an all-time high. And then the stock market in Japan started to drop. You know when it got back to that previous all-time high? Last year.
When?
It took 35 years for people to get back to where they were. If you were a stock investor in Tokyo and you had all your money in Japanese stocks, and you had whatever you had, a million yen or 2 million yen or whatever, and you retire at 60 or 65 at the end of 1989, you think, okay, I've got enough money now. The fact of the matter is that portfolio went down for the next 2 or 3 years, and then it took another 30 years to get back up to where it was at the end of 1989. So when people say take a long-term view, that is generally true, but a lot of people don't realize how long the long term might have to be. I mean, that's an extreme example. I think many people think that the Japanese stock market in the late 1980s was perhaps the biggest bubble of all time, and so I don't think that we should be worried about something quite that bad. But if we have something half as bad, you know, what if markets dropped today and it took you 15 years? What if it took you 10 years? What if it took you 5 years to get back to where you were? It's not just do you have enough money, but also do you have the steely resolve to stick with your plan? A, was your plan appropriate to begin with? And B, will you stick with it until you can actually come out of this lull, this dip, to actually be able to resume doing what you were doing and maybe make some lifestyle sacrifices along the way? Because remember, I say you can take out more if the market goes up, but if the market hasn't recovered to its previous highs, maybe you should just take out the minimum. Does that mean you're prepared to not go to Greece for the next 5 years when you've been wanting to go to Greece for the past 5 years? And you say, okay, well, now in 2025, this will be our year. And then if markets go down in 2025, how long are you prepared to defer that trip that you've already been deferring? And some people might have to make some sacrifices. So the book is about how optimism bias is a threat to your finances because the financial services industry talks about being optimistic, and being optimistic is a great way to gather assets and to get people to write you a check and to save more and to do more things, because everyone's motivated by the vision of being retired and sitting in a deck chair by a beach or by a pool and sipping margaritas and having a great time with your spouse and having wonderful kids that are launched and happy. But there's a reason companies use that kind of imagery in their advertising campaigns and whatnot. It's because it motivates people positively to do what they want them to do, which is to give them their money, which is usually a very good thing. I'm not trying to suggest it's a bad thing. You just need to understand that the industry is doing things that are good for the industry, that you need to be careful about how you internalize that and act on it yourself, because life will happen and you may need to put a little bit of water in your wine from time to time as markets evolve.
Okay. Wow. That is a lot to digest. And if somebody is panicking a little bit right now, listening to this, thinking, oh my gosh, maybe I shouldn't be that optimistic. Maybe I shouldn't completely trust my advisor. What do you say to that person who just went into panic mode?
So first off, I don't think advisors are bad people. I'm an advisor. I'm not trying to sound like advisors are part of some nefarious cabal that are trying to do bad things. They are
Mm,
overwhelmingly good people. Um, every industry has its lemons, but it's not
Mhm.
like advisors or I would think they're actually, my wife's a lawyer, so, I can make fun of lawyers. But if you compare them to other professionals, doctors, dentists, lawyers, accountants, it's the usual things. These are people that are generally quite dedicated to their craft, want
Mhm.
things to go well, thoughtful, and you have varying degrees, but I think for the most part, these are good people with good intent. Financial
Okay.
advisors in
Mhm.
2025, if you ask them what their job is, they will increasingly not say it's about maximizing return or lowering risk or managing taxes or planning your estate or having the right amount of insurance. They will say that a big part of their job on a day to day basis is constructive behavior modification. They'll say, I'm not so
Mhm.
much a money coach as I am a behavioral coach.
Mhm.
So if you want to work with an advisor, and again, there are lots of people who might be listening to this podcast who are do-it-yourself investors. That's fine too. Again, if you're a do-it-yourselfer, you should probably get a buddy to bounce your ideas off. But there's nothing wrong necessarily with being a do-it-yourselfer. You just need to know there are risks. Financial advisors should, in theory, and most of the time in practice, be able to act as that sounding board to say, this is what I think you should do, and this is why I think you should do it. I should also mention that there are different advisors. So I work as a portfolio manager. So my clients give me discretion. So part of why I became a portfolio manager is I learned something in the global financial crisis of 2007 to 2009. I was calling my clients to say, we have an investment policy statement, we have a portfolio blueprint, and you're supposed to buy low and sell high. And now that stocks have gone down, we should take some of your money out of bonds and put it into stocks. And my clients were saying, John, are you out of your tree? Like stocks are dropping. We don't want to buy. But we agreed. We have it in writing. You said you were going to be doing this. Well, and then they give you a story and they won't do what they promised you they would do when this circumstance arose. And that's especially problematic for people that are still working because they actually have an opportunity because they can buy the dip. Retirees can't do that. So one of the things that I made the decision in 2009 when the global financial crisis ended that I would become a portfolio manager so that I could work with what's called discretion, which is to say, as long as I'm sure that I understand the client's risk profile, I can make the buy and sell decisions without getting them to sign off on it. I can just act as a benevolent dictator, if you will, as a person who actually tries to do what's right for the client for all the right reasons, do all the right things for all the right reasons, but to remove the impediment of client emotion from the equation.
Mhm.
Because
Mhm.
when you try to get them to do what they said they knew they had to do, and they promised you they would do, if they won't give you the go ahead, and you need the go ahead in your role as an advisor, and you can't get it, then you can't help them because they're stuck in this fear. They're
Mhm.
paralyzed by fear. If you can take that fear away, then you can help them by just doing what needs to be done without having to have that awkward conversation. So, in my mind, that's actually better. And but that's something that it took me half a career to realize needed to happen before I started doing things differently.
Mm. So that's if you're managing a portfolio, and you said there are different types of advisors. So what are one or two other kinds that are out there
So
that people should be
so
aware of?
the two main advisors, and I'm not
Mhm.
exactly sure the nuances between Canada and the US, but you'll have
Mhm.
people that will work at a major firm at a wirehouse, and they'll be sort of tied into using that firm's products and
Oh, okay.
recommended list and whatnot. You will have
Mhm.
other people who will be RIAs, registered investment advisors, which is the growing channel in the US, and there are analogous things here in Canada. And
Mhm.
the RIAs are able to oftentimes have a wider product shelf, but in all instances, you have to be careful to see whether or not that advisor, whether he or she is at a wirehouse or at an RIA or anywhere else, has discretion. If they have discretion, then they are a portfolio manager. And if they're a
Mm.
portfolio manager, they are a fiduciary. They have to
Got
do
it.
what is best for the client. And I think I'm not exactly sure, so don't quote me on this, but I think in the US, if you're an RIA, you are also a fiduciary as a result of being an RIA, whereas you are not necessarily a fiduciary. You're more of a sales rep if you're working at a
Mm.
wirehouse.
Okay. All right. Thank you for explaining it simply enough. I have, like I told you earlier before we jumped on to this interview, I love learning about finances, but it can be very overwhelming. So if somebody out there has not even attempted to learn, some of this information can seem daunting, overwhelming. It's very similar to time management. You're getting all of this information and it's great information, but then the brain just starts to hit the maximum and stop intaking. So if somebody has hit that point right now from all of this wonderful information, what advice would you give to them as far as what's the first step that they can take on their financial journey, just to take that one baby step forward, and then they can start looking into the rest of the information later?
I would say that your local library and YouTube are your friends. So if you're interested enough to buy a book or to
Mm,
just sign out a book, find a good book on personal finance. And again, the credibility of the author is important because there are some people who will write books as a shill to generate business, and they're not necessarily the most credible. So do some due
mm,
diligence on the books. But usually, if it's a bestseller, it will be a book that will have, it's only a bestseller because it has some credibility. So, try to find that. Similarly, ChatGPT is your friend. If you want to plug in a search for how to save for retirement, how to find a credible advisor, how to make better financial decisions, whatever, plug it in, see what comes up. And I'll give you another example of a bias that we all have. So I will ask you to resist it. There is a bias called confirmation bias. And confirmation bias is if you have a preconceived notion of what's right or of what to do, when you do your research to try to find evidence in terms of whether you're right or wrong, this has been shown 5 ways till Friday. People they'll go and the search will come up and they'll have like 20 entries on subject X. People will go, "Oh, this seems like a viewpoint that I think is right," and they'll click on that, and they will literally choose the first entry that they think intuitively coincides with their pre-existing viewpoint, which is to say they're not really trying to learn. They're looking for reassurance that what they thought going into the decision was correct. And then they say, well, see, I Googled it and see this came up. And then they say, well, see, I made a good, quick decision. So in those cases, you do need to be a little more deliberative. Look at maybe the top 4 or 5 answers, see what they say. Don't just take the first one that comes up or the first one that you agree with as being some gospel way of looking at whatever problem is that you're trying to solve or whatever
mhm.
question is you're trying to have answered. But be thoughtful, be deliberative. I would also say if there are people that that are successful, in my podcast, I talk about how it's good to network. And if you know someone in your community because he's a business leader or because you know that she has an interest in personal finance and has read books or maybe has taken some college courses on finance or on economics, don't be afraid to ask these people for their input and ask them, well, what book should I read? Well, what podcast should I listen to? Well, what YouTube presentation should I watch? Because what you learn will depend a lot on what your interest is, and it's beyond the purview of the mandate of this podcast to try to give a one size fits all answer, because some people will be concerned about budgeting and some people will be concerned about investing, and some people will say, I got budgeting and investing down, I just want to pass my assets on to my kids and grandkids. And those are all valid concerns, but where you look for those are all very different questions, and you just have to do some purposeful due diligence when you look for the answers.
So important. Well, John, you have been a wealth of information, pun intended. I have a feeling that people are going to definitely want to find out more about you and the kind of advice and recommendations that you give. So, can you please share with us how can folks get in touch with you to find your books, to listen to your podcast, or just go to your website to find out and
Okay,
connect with you?
let's do all three. My website
Okay.
is johndegooey.ca. So that's JOHNDEGOE.ca because I'm a Canadian. Secondly, you can get my book on Amazon or Barnes and Noble or wherever you get books. The book is called Bullshift, Bullshift. T, there is an F. And the subtitle is How Optimism Bias Threatens Your Finances. And finally, and perhaps maybe most importantly, my own podcast is called Make Better Wealth Decisions. And I interview guests much like you do, where we talk about decision making and the biases that we all have. Sometimes we talk about how products fit. Sometimes I talk to journalists. Sometimes I talk to academics. But the theme throughout all of the interviews is making better wealth decisions. And there's a lot that goes into purposeful decision making. So please consider liking and subscribing to Make Better Wealth Decisions.
Excellent. And we will be sure to put the links to all of those websites that you just gave to us in the blog, in YouTube, wherever this podcast is going to be broadcast. John, thank you so much for being here today, for sharing your information with us, and I wish you well.
You too. My pleasure. Take care.
You too.